Let's get more in the jobs picture now. For that, we turn to Russell Price. Russell is a senior economist at Ameriprise Financial, one of our Bloomberg best. That means he's one of the most accurate forecasters in the world. He's joining us now from our newsroom in Detroit. Russell, thank you so much for joining us. We really appreciate it.
Thanks for having me.
So why do you think that we got this unexpected drop in that ADP number?
Well, I think clearly it was disappointing, and I think traders may lighten their books a little bit tomorrow ahead of the employment report, considering that the market's on a holiday Friday morning when the Labor Department will release the report. But I think there's three factors that I would point to that the reasons why we're still optimistic about the employment report on Friday versus today's ADP report. First of all, the ADP report is a fairly poor track record in predicting the non-farm payrolls number that always comes out 2 days later. Also, because of the methodologies that are used to develop both reports, the ADP report does not really get the same boost, or was not expected to get the same boost as the Labor Department report will from the February snowstorms.
Russ, just a quick question here. I mean, I know you're an economist and not a trader per se, but why do you think the market then reacts so sharply when these numbers do come out if there isn't that correlation?
Well, obviously any report on the employment prospects right now is poor. We absolutely need to see improved employment right now in the economy for the recovery to be sustained. Consumers are participating in the recovery, but really they're bringing down the savings rate again. And that can't continue forever. We need to see employment grow so that consumers have the income that they need as fuel to maintain their spending and recovery. So anything related to employment is important.
Isn't this the circle, though, that employment can't pick up unless their incomes are there to spend the money for the goods that then companies need to hire? In other words, where's the sort of tipping point here where people can start hiring again?
Well, I think already we've seen pretty clear evidence that companies are really pushing their current workers to the absolute limit. If you look at labor productivity has spiked over the last year at a pace that we haven't seen in the last 60 years that the Labor Department's track such data. So they're really pushing their current workforce to the absolute limit. They need to start hiring soon because that really can't be maintained that much longer. Also, we've seen temporary help as a percentage of the workforce also spike at an unprecedented rate over the last 6 months. That also cannot be contained or continued. So I think employers do have to start hiring here soon, so long as they continue to get those orders in the door.
Russ, I'm curious, given the productivity and how it has been for the past few months in particular, going to relatively high levels, even as companies start hiring again, do you think that they're going to keep that hiring limited because they still do expect to get so much out of their workers? And how long might that effect last?
Well, if we look back historically at productivity spikes, again, this has been the biggest one we've ever seen. If we look at past productivity spikes, they're not really sustainable for too much longer. In fact, they're really not sustainable for that long at all. And what we've seen is historically, in past spike periods, we've seen non-farm payrolls jump by 25%, or have been 25% higher than their average rate in the year after we get such productivity spikes. So the influence is really quite strong.
All right, we'll keep looking for that correlation. Russ, thanks a lot for talking to us about this. We'll be looking forward to the jobs report on Friday. Also, Russ Price, senior economist at Ameriprise Financial.